Have you ever wondered how the wealthy manage to grow their fortunes while paying less in taxes than most of us? What if you could legally reduce your tax burden and use the savings to build your financial future? In Tax-Free Wealth, Tom Wheelwright reveals how the tax code is not something to fear, but a powerful tool that, when understood, can help you achieve true financial independence. Stay tuned as we dive into the strategies that could change the way you think about taxes forever. Chapter 1. Why Taxes Aren't Your Enemy. Picture this. You've just received your paycheck, and as usual, a significant chunk has been taken out for taxes. It's a routine many people are all too familiar with, and for most, it's accompanied by frustration, confusion, and maybe even a touch of resentment. Why do we have to pay so much? What is all this money even going toward? Is there any way out of this? These are the questions that haunt most of us as we look at the growing list of deductions that carve into our hard-earned income. But what if there was another way to think about taxes? What if, instead of dreading tax season, you could look forward to it, knowing that you were going to keep more of your money and grow your wealth at the same time? This is the paradigm shift that Tom Wheelwright presents in Tax-Free Wealth. He invites us to look at the tax code not as a collection of punitive laws, but as a blueprint for financial success. In fact, he argues that the tax system is designed to help us become wealthier, if we know how to use it. The key, Wheelwright explains, lies in understanding the purpose of the tax code. Most of us see taxes as the government's way of taking our money to fund public services, and while that's partially true, it's not the full picture. What many don't realize is that the tax code is also a series of incentives. Governments want certain behaviors to be encouraged, whether that's investing in renewable energy, creating jobs through entrepreneurship, or promoting housing development through real estate. To make these things happen, they offer significant tax breaks to those who engage in these activities. In other words, the tax code is filled with opportunities for those who know where to look. It's here that Wheelwright introduces the idea that taxes are not your enemy. They are your potential ally. For decades, the wealthy have used the tax code to their advantage, legally reducing their tax liability while growing their fortunes. This is not about shady loopholes or secret offshore accounts. It's about understanding the incentives built into the tax system and using them to your benefit. Wheelwright challenges the conventional thinking that paying taxes is an inevitable burden, showing that by shifting your mindset, you can change the trajectory of your financial life. Imagine if, instead of seeing taxes as something that takes away from your wealth, you saw them as a tool that could help you achieve financial independence. This is the core message of Tax-Free Wealth. But Wheelwright is quick to point out that most people are unaware of these possibilities because they've been conditioned to believe that taxes are a fixed expense, something that can't be controlled or influenced. In reality, nothing could be further from the truth. What sets this book apart is its emphasis on the idea that the tax code is essentially a game. Like any game, there are rules, and those who know the rules and play by them tend to win. Wheelwright draws parallels between the strategies used by the wealthy and the opportunities available to everyday people who are willing to learn. The tax system, he argues, is not biased in favor of the rich. It's simply that the rich know how to play the game better than everyone else, and that's not because they're smarter or more capable, but because they have access to better information. Wheelwright's tone is both encouraging and empowering. He wants you to understand that anyone, regardless of income level, can learn to minimize their taxes legally. The real barrier isn't the complexity of the tax code, it's the way we've been taught to think about taxes. Most of us only think about taxes when we have to file a return once a year, and even then, our goal is just to get it over with as quickly as possible. But Wheelwright emphasizes that this reactive approach is precisely what keeps most people from benefiting from the tax system. Instead of thinking about taxes as a once-a-year obligation, we should be thinking about them as an ongoing part of our financial strategy. As Wheelwright tells it, the tax code is not something to be feared or resented. It's a tool, a roadmap for wealth creation. And like any map, it only works if you know how to read it. That's where this book comes in. Wheelwright promises to take you step by step through the process of understanding the tax code and implementing strategies that will allow you to keep more of your money and grow your wealth. The first chapter sets the stage for the rest of the book, which delves into specific strategies for reducing taxes. But before diving into the details, Wheelwright wants you to shift your mindset. The tax code is not your enemy, it's a guidebook. And the sooner you start thinking of it that way, the sooner you can begin to unlock its potential. Chapter 2: The Roadmap to Wealth. Now that you've begun to see taxes in a different light, as something that can work for you rather than against you, Tom Wheelwright takes you deeper into the concept of how taxes are part of a larger strategy to build lasting wealth. In this chapter, Wheelwright compares the tax system to a roadmap. Imagine you're on a long road trip, but instead of taking the shortest, most efficient route to your destination, you meander through back roads, taking unnecessary detours and getting lost along the way. The result? You waste time, energy, and resources. This, Wheelwright explains, is how most people approach their financial journey, particularly when it comes to taxes. But what if you had a clear map showing you the fastest route to wealth? This is exactly what the tax code can be if you understand how to use it. Instead of getting lost or making unnecessary stops, the tax code can guide you directly to financial success, with fewer obstacles and more resources in your pocket. The key is learning how to navigate the system. In this chapter, Wheelwright breaks down the notion that taxes are something that happens to you. Instead, he says, taxes are something you can control if you know the rules of the game. It's about working smarter, not harder. This chapter shifts the focus from the fear and frustration surrounding taxes to seeing them as a vital part of a long-term strategy that can help you grow your wealth and achieve financial freedom. Think about it like this. If you're a business owner or an investor, you're already making decisions that affect your financial future every day. You decide where to invest your time, your money, and your energy. What Wheelwright wants you to realize is that taxes should be part of these decisions from the start, not something you deal with after the fact. Most people, he argues, treat taxes reactively. They file their returns once a year, hoping they haven't made any mistakes, and then forget about it for another 12 months. But this mindset is exactly what keeps most people from fully benefiting from the tax code. Instead, Wheelwright introduces the idea of proactive tax planning. This means thinking about taxes throughout the year and making financial decisions with an eye toward how they will impact your tax liability. The wealthy do this all the time. They're not waiting until tax season to see how much they owe. They're strategizing all year long to minimize their taxes and maximize their wealth. One of the key elements Wheelwright highlights in this chapter is the importance of having a plan. Just as you wouldn't embark on a cross-country road trip without a map or a GPS, you shouldn't approach your finances without a tax strategy. A well-thought-out tax plan can save you thousands, if not tens of thousands, of dollars each year. Money that can be reinvested into your business, your investments, or your personal wealth-building goals. At this point in the story, Wheelwright addresses a common misconception. Many people believe that only the super wealthy can benefit from the tax code because they can afford expensive advisors and complex strategies. But this couldn't be further from the truth. The tax benefits that the wealthy enjoy are available to everyone. They're just more accessible to those who understand how to use them. You don't need millions of dollars or a team of accountants to take advantage of the tax code. You simply need knowledge and a willingness to learn. Wheelwright emphasizes that the tax system is designed to encourage specific behaviors, things like investing in real estate, starting a business, or creating jobs. These are activities that benefit the economy as a whole, so governments provide incentives in the form of tax breaks to encourage them. By aligning your financial decisions with these incentives, you can dramatically reduce your tax liability and grow your wealth at the same time. It's all about knowing where the incentives are and how to use them to your advantage. One of the most important lessons Wheelwright imparts in this chapter is that wealth building is not just about making more money, it's also about keeping more of the money you make. You can be the highest earner in the world, but if you're paying too much in taxes, you're giving away a significant portion of your hard-earned income. The wealthy understand this, which is why they focus not just on increasing their income, but on maximizing the income they get to keep. To drive this point home, Wheelwright uses the metaphor of a bucket with holes in it. Imagine you're filling up a bucket with water, but the bucket has several holes at the bottom. No matter how much water you pour in, a lot of it leaks out. This is what happens when you don't have a tax strategy. You're losing money through the holes in your financial plan, most of which are caused by unnecessary tax payments. The goal, according to Wheelwright, is to plug those holes by understanding how the tax system works and using it to your advantage. By the end of this chapter, you'll begin to see the importance of proactive tax planning. Taxes are not just something to deal with once a year, they're an integral part of your financial journey. And with the right strategy, they can help you keep more of what you earn, allowing you to invest that money back into your wealth-building goals. The roadmap to wealth is clearer than ever, and Wheelwright is ready to guide you through it step by step. Chapter 3: The Importance of a Tax Strategy. Imagine a chess game where every move counts. Every decision you make either brings you closer to victory or leaves you vulnerable to your opponent's attack. Now consider your financial life. Like chess, every financial decision you make, whether it's buying a home, investing in stocks, or starting a business, can have long-term consequences. But what if you could make these decisions with the foresight of a grandmaster, anticipating the tax consequences of every move you make? This is where having a solid tax strategy comes in, and it's what Tom Wheelwright emphasizes in this chapter of Tax-Free Wealth. Most people approach taxes with a singular goal: filing their returns correctly and on time. They hand off their paperwork to an accountant or use tax software, hoping that everything is in order. But what Wheelwright reveals is that this reactive approach, what he calls tax compliance, is just the bare minimum. It ensures you follow the rules, but it does little to improve your financial situation. In contrast, those who are serious about building wealth focus not just on compliance, but on tax strategy. And there's a big difference between the two. Let's break it down. Tax compliance is about reporting what has already happened, your income, expenses, and any deductions you qualify for based on past actions. Tax strategy, on the other hand, is forward-looking. It's about planning for the future, making decisions that will impact your taxes in the months and years to come. A solid tax strategy allows you to minimize your tax liability legally by aligning your financial actions with the tax incentives offered by the government. Wheelwright explains that most people are unaware of the opportunities they're missing because they view taxes as something to be dealt with once a year. But imagine if you thought about taxes as an integral part of every major financial decision. When you're buying an investment property, for example, are you thinking about how the depreciation of that property will reduce your taxes? When you're starting a new business, have you considered the tax benefits of structuring your company as an LLC or an S corporation? These are the kinds of questions that people with a tax strategy are asking, and they're saving thousands, sometimes even millions, of dollars as a result. A key point Wheelwright makes in this chapter is that tax planning isn't just for the wealthy. Yes, it's true that many high-net-worth individuals have tax strategies in place, but these strategies are available to anyone who takes the time to understand them. The tax code is full of incentives, many of which are designed to encourage behaviors like investing in small businesses, real estate, and renewable energy. By aligning your financial decisions with these incentives, you can reduce your taxes while building wealth. One of the biggest advantages of having a tax strategy is the ability to anticipate and plan for tax deductions. Wheelwright walks us through the process of identifying tax-deductible expenses, costs that can be subtracted from your taxable income. This means that for every dollar you spend on a deductible expense, you're effectively reducing your tax bill. The key is knowing which expenses qualify as deductions and how to document them properly. For example, if you own a business, many of your operating expenses, things like rent, utilities, travel, and even meals with clients, can be deducted from your taxable income. This doesn't mean you should spend recklessly just to claim more deductions, but it does mean that if you're already spending money on these things, you should be taking full advantage of the tax benefits. A well-planned tax strategy ensures that you're keeping track of these expenses throughout the year and that you're prepared to claim them when tax season rolls around. But tax strategy goes beyond just deductions. Wheelwright introduces the concept of tax credits, dollar-for-dollar reductions in the amount of taxes you owe. Unlike deductions, which reduce your taxable income, tax credits directly reduce your tax liability. These can be incredibly powerful tools for lowering your tax bill, but they're often overlooked by those who don't have a tax strategy in place. Wheelwright emphasizes that understanding the difference between deductions and credits, and knowing when and how to claim them, can make a huge difference in your overall tax burden. Another critical aspect of tax strategy is timing. When you make financial decisions can be just as important as what decisions you make. For instance, if you're planning to make a large charitable donation, it might make sense to do it in a year when you have higher taxable income, allowing you to offset more of that income with the donation. Similarly, if you're expecting to sell an asset like real estate or stocks, understanding how the timing of that sale will impact your taxes can save you a significant amount of money. Wheelwright stresses that tax strategy isn't something you can think about just once a year. It's an ongoing process that requires attention to detail and foresight. At this point, you might be wondering, is this really something I can do on my own? Wheelwright is clear that while it's possible to learn the basics of tax strategy on your own, it's often beneficial to work with a tax advisor who understands your personal financial situation. However, he also warns that not all tax advisors are created equal. Many accountants are trained to focus solely on tax compliance. They help you file your returns correctly, but don't offer much in the way of strategic advice. This is why finding the right advisor is crucial. Wheelwright encourages you to seek out a proactive tax advisor, someone who isn't just thinking about the past, but is also helping you plan for the future. The best advisors are those who understand the tax code inside and out and who can guide you in making decisions that align with your financial goals. But even if you're not working with an advisor, the most important thing is to start thinking about taxes strategically. Every financial decision you make has tax consequences, and the more you can anticipate and plan for those consequences, the better off you'll be. By the end of this chapter, the message is clear. Having a tax strategy is essential if you want to build wealth and achieve financial freedom. Taxes are not something to be dealt with reactively. They're a part of your financial life that requires careful planning and forethought. With the right strategy, you can minimize your tax burden and keep more of your hard-earned money. And as Wheelwright reminds us, this isn't just for the rich, it's for anyone who's serious about taking control of their financial future. Chapter 4. The Power of Deductible Expenses. As you start to wrap your mind around the idea of tax strategy and proactive planning, it's time to zoom in on one of the most powerful tools in your tax-saving arsenal: deductions. In Chapter 4 of Tax-Free Wealth, Tom Wheelwright introduces the concept of deductible expenses. And here's where things get exciting. Imagine being able to reduce your taxable income significantly just by understanding which of your everyday expenses can legally count as deductions. This chapter is where you begin to realize that taxes, when approached strategically, can allow you to hold on to more of your money than you ever thought possible. Wheelwright opens this chapter by asking us to reconsider something we all do every day: spending money. Every time you buy something for your business, whether it's a new computer, office supplies, or even a business lunch with a client, you may be able to deduct that expense from your taxable income. What's exciting about this is the fact that you don't need to be a billionaire or own a massive corporation to benefit. These deductions are available to anyone who takes the time to learn how the tax system works. Now, the key to fully benefiting from deductions is understanding what qualifies as a deductible expense and how to document it properly. This is where many people, especially small business owners and freelancers, miss out on significant tax savings. Wheelwright walks us through the most common categories of deductible expenses, offering real-world examples to show how you can take advantage of them. Let's start with business expenses. If you run a business, whether it's a full-time enterprise or a side hustle, there are numerous opportunities to reduce your tax liability through deductions. Wheelwright explains that virtually every dollar you spend to operate your business can potentially be deducted, as long as the expense is both ordinary and necessary. This is an important distinction. Ordinary means that the expense is common and accepted in your trade or business, while necessary means that it's helpful and appropriate for your business activities. For instance, if you work from home, you may be able to deduct a portion of your rent or mortgage, utilities, and internet costs as business expenses. The key is to calculate what percentage of your home is used exclusively for business purposes. Many people are unaware of this deduction or are unsure of how to claim it properly, leaving money on the table each year. Next, Wheelwright explores travel expenses, another area where deductions can make a big difference. If you travel for business, whether it's to meet clients, attend a conference, or scout new opportunities, your travel-related expenses, airfare, lodging, meals, and even a portion of your entertainment expenses can be deducted. But here's the catch. The trip must be primarily for business purposes. If you mix business with pleasure, only the business portion of the trip can be deducted. Wheelwright stresses the importance of keeping detailed records, including receipts and notes about the business purpose of your trip, to ensure that you qualify for these deductions. Meals and entertainment are another category that often goes underutilized. If you're having a business meeting over lunch or entertaining clients as part of your work, those costs can be deducted, though there are limits on how much of the expense can be written off. As of the most recent tax laws, you can typically deduct 50% of the cost of meals and entertainment that are directly related to your business. Once again, keeping accurate records is crucial. Wheelwright recommends jotting down the names of the people you meet with and the business purpose of the meeting on the back of the receipt as a simple way to ensure that your deductions hold up if you're ever audited. This chapter also delves into one of the most misunderstood areas of deductions: depreciation. Depreciation allows you to deduct the cost of an asset, such as real estate, equipment, or vehicles, over time rather than all at once. It's a way for the government to recognize that certain assets wear out or become less useful over time, and therefore, their cost should be spread out over the years that the asset is in use. For example, if you purchase a piece of equipment for your business, you might be able to deduct a portion of its cost each year over its useful life. Depreciation is particularly important for real estate investors, as it allows them to deduct a significant portion of the cost of their properties over time. Wheelwright explains that even though your property might be appreciating in value, the tax code allows you to take depreciation deductions as if it were losing value. This is one of the reasons why real estate is such a tax-advantaged investment. You get to deduct the wear and tear on your property even as it increases in market value. By the time you reach this point in the chapter, you start to realize just how much money you might be leaving on the table if you're not taking full advantage of these deductions. Wheelwright encourages readers to look at their spending habits through a new lens, one that's constantly evaluating whether each dollar spent could potentially reduce your tax liability. Every business-related purchase is an opportunity to keep more of your income. One of the key takeaways from this chapter is that documentation is everything when it comes to deductions. The tax code is very clear about the need for accurate, detailed records to support your deductions. Wheelwright suggests that one of the easiest ways to stay on top of your documentation is to keep all receipts and maintain a log of your business-related activities. This might seem like a lot of work at first, but when you consider the potential tax savings, it's a small price to pay. In addition to keeping track of receipts, Wheelwright advises working closely with a tax advisor who understands the ins and outs of deductions. Not all expenses are deductible, and some may be subject to special rules or limitations. Having a knowledgeable advisor can help you avoid mistakes and ensure that you're maximizing your deductions without crossing any lines that could trigger an audit. As the chapter draws to a close, Wheelwright reminds us once again that the tax code is not a punitive system designed to take your money. It's a tool that rewards those who know how to use it. Deductions are one of the easiest ways to reduce your tax burden, and they're available to anyone willing to put in the effort to learn the rules. Whether you're a business owner, an investor, or just someone looking to keep more of your hard-earned income, understanding deductions is a crucial step toward achieving financial independence. With this newfound understanding of deductible expenses, you're starting to see how the tax code is designed to reward smart financial decisions. The next step is to explore another powerful tax-saving tool: depreciation. This is where things get even more interesting. as we'll see in the next chapter. Chapter 5: The Magic of Depreciation. Now that you've discovered the power of deductions, you're likely feeling more empowered to manage your financial life in a way that helps you keep more of your hard-earned money. But as Tom Wheelwright takes us deeper into tax-free wealth, we reach a truly magical aspect of the tax code: depreciation. If deductions felt like a cheat code, depreciation will feel like the ultimate power-up, especially for investors. In this chapter, Wheelwright shows us how depreciation can help you keep even more income in your pocket while investing in valuable assets that increase your wealth over time. Depreciation is, in its simplest terms, a way for the government to recognize that certain assets lose value over time. When you buy something like real estate, equipment, or machinery for your business, the tax system doesn't expect you to pay for that asset all at once when it comes to tax deductions. Instead, they let you spread out the cost of the asset over several years, allowing you to deduct a portion of that asset's value each year. This is what's known as depreciation. But here's where things get interesting, and this is the part that many people, especially new investors, often overlook. In many cases, the assets you're depreciating, like real estate for example, aren't actually losing value in the real world. They're appreciating. Imagine owning a piece of real estate that increases in value each year, but from a tax perspective, you're allowed to treat it as if it's losing value and take a tax deduction for that depreciation. This, Wheelwright explains, is one of the most powerful tools available to investors. Think of depreciation as a phantom expense. It's not something you're paying out of pocket year after year, but it still reduces your taxable income. Wheelwright emphasizes that understanding how to use depreciation correctly can result in significant tax savings. This chapter focuses heavily on real estate because it's one of the most common ways people can benefit from depreciation, but the principles apply to other types of assets as well. Real estate is often described as the investor's dream, and much of that has to do with the tax benefits, particularly depreciation. When you purchase a property, the IRS allows you to depreciate the structure, not the land itself, over a period of 27.5 years for residential properties and 39 years for commercial properties. Each year, you can take a portion of the property's cost and deduct it from your taxable income. This is a huge benefit because it reduces your tax bill without actually costing you any money. After all, you already paid for the property when you bought it. Let's break it down with an example. Say you purchase a rental property for $500,000. You'll need to separate the cost of the land from the cost of the building, because only the building can be depreciated. Let's say the land is valued at $100,000 and the building at $400,000. Using the IRS's rules for residential property, you can depreciate that $400,000 over 27.5 years, which means you can deduct about $14,545 each year from your taxable income for the next 27.5 years. That's a significant tax saving year after year, and it doesn't even account for other deductions like mortgage interest or repairs. But depreciation doesn't stop at real estate. Wheelwright points out that many other assets, such as equipment, vehicles, and even some intellectual property, can be depreciated. If you own a business, the equipment you use, whether it's computers, machinery, or even furniture, can be depreciated over time. This allows you to offset some of the income your business generates, reducing your overall tax liability. Depreciation is such a powerful tool because it allows you to recover the cost of an asset without actually spending any money in the current tax year. It's a paper loss, a way to reduce your taxable income even though you're not incurring any real losses. And while it may seem complex at first, Wheelwright breaks it down in such a way that even someone without a financial background can understand its benefits. One of the most fascinating aspects of depreciation is that it can be accelerated in certain circumstances. This means you can take larger deductions in the early years of owning an asset, rather than spreading them out evenly over the entire depreciation period. This is where tools like bonus depreciation and Section 179 expensing come into play. Wheelwright explains that bonus depreciation allows you to deduct a large percentage of an asset's cost in the year it's purchased rather than depreciating it over its useful life. This is particularly useful for businesses looking to reduce their tax bill in a year when they make significant investments in equipment or property. The U.S. tax code, as of the writing of Wheelwright's book, allows businesses to take 100% bonus depreciation on qualifying property, which means you can write off the entire cost of an asset in the first year. This provision has been a game changer for many small and medium-sized businesses, as it allows them to invest in the growth of their operations while significantly lowering their taxes. Section 179 expensing works similarly, allowing businesses to deduct the full purchase price of qualifying equipment in the year it's placed into service, up to certain limits. But what about the downsides? Is there a catch to all this? Wheelwright addresses this question by explaining the concept of recapture. When you sell an asset that you've depreciated, the IRS will want to recapture some of the tax savings you've received through depreciation. In other words, you'll have to pay taxes on the depreciation deductions you've taken over the years when you sell the asset. However, even with recapture, the benefits of depreciation far outweigh the costs in most cases. The tax savings you realize while you own the asset can be reinvested, allowing you to build more wealth before you're required to pay the recapture taxes. What's more, Wheelwright reminds us that there are strategies to minimize the impact of recapture. For example, if you hold on to the property until your death, your heirs will receive the property at its stepped-up value, meaning they won't have to pay taxes on the depreciation you took during your lifetime. This is one of the reasons why real estate is such a powerful tool for generational wealth building. By understanding the rules of depreciation, you can not only reduce your tax liability while you own the property, but also pass on significant assets to your heirs tax-free. As Wheelwright brings this chapter to a close, he reinforces the idea that depreciation is one of the most misunderstood yet most powerful tax-saving tools available. It's not just for the wealthy or for large corporations. Anyone who owns depreciable assets can benefit. The key is to understand how depreciation works and to plan your investments accordingly. Whether you're investing in real estate, starting a business, or purchasing equipment, depreciation allows you to reduce your taxes while building wealth. By now, you should be seeing the bigger picture. The tax code isn't just a series of rules you have to follow. It's a roadmap that, when used correctly, can help you achieve financial independence. In the next chapter, Wheelwright explores how real estate, in particular, can be a game changer for anyone looking to build wealth, with or without a large amount of starting capital. Chapter 6. Real Estate, the Investor's Dream. Now that you've gained a deeper understanding of the powerful tax benefits that come with depreciation, you're ready to explore one of the most tax-advantaged investments out there, real estate. In Tax-Free Wealth, Tom Wheelwright introduces real estate as the ultimate investor's dream, and for good reason. Real estate not only offers the opportunity for long-term wealth creation, but it also provides a host of tax benefits that can help you significantly reduce your tax liability while growing your assets. This chapter dives into why real estate is such a powerful tool for wealth building, and how you can take advantage of it, even if you're starting with modest capital. Real estate is often associated with high-net-worth individuals and institutional investors, but Wheelwright emphasizes that the tax benefits available to real estate investors are accessible to anyone who's willing to learn and take action. Whether you're investing in a single-family home to rent out, purchasing a multifamily property, or getting into commercial real estate, the tax code is designed to reward real estate investors. And while real estate may seem daunting to those unfamiliar with it, Wheelwright assures us that it's one of the most straightforward paths to building wealth when you understand the tax advantages. At its core, real estate investment offers two powerful wealth-building opportunities: appreciation and cash flow. Appreciation refers to the increase in the value of your property over time, while cash flow refers to the income you generate from renting out the property. But beyond these two benefits, the tax advantages of real estate investing are what truly make it stand out. Wheelwright explains that the tax code favors real estate investors because property investment stimulates the economy. Real estate provides housing, creates jobs in construction and property management, and generates economic activity. In return, the government offers significant tax incentives to encourage more investment in this sector. One of the most important tax benefits associated with real estate is the ability to deduct expenses related to the property. As with any business, real estate investors can deduct a wide range of expenses that are necessary for maintaining and operating their properties. These include mortgage interest, property taxes, insurance, repairs, and maintenance. But what's even more powerful is the ability to deduct non-cash expenses like depreciation, which we covered in the previous chapter. In fact, real estate is one of the few investments where you can deduct a portion of the property's cost each year through depreciation, even as it increases in value. This means you're generating wealth through appreciation and cash flow while simultaneously reducing your taxable income through depreciation deductions. It's like a triple win for investors. The ability to leverage depreciation is one of the main reasons why real estate investors pay far less in taxes than people who earn similar amounts of income from wages or other investments. Wheelwright highlights the concept of leveraging in real estate as another reason why it's such a powerful investment vehicle. Leverage is essentially using borrowed money, such as a mortgage, to purchase a property. Real estate is unique in that you can borrow a significant portion of the purchase price, often 70% to 80%, while still being able to deduct the full amount of depreciation on the property. This allows you to control a valuable asset while putting in only a fraction of the total cost up front. The tax benefits, like depreciation, are calculated based on the total value of the property, not just your down payment. So, if you've purchased a $500,000 property with $100,000 of your own money and $400,000 from a mortgage, you still get to depreciate the full value of the property, not just the portion you paid for. Leverage also allows you to magnify your returns. When you invest in real estate using borrowed money, the income and appreciation generated by the property are based on the full value of the asset, not just your initial investment. For example, if a property appreciates by 5% in a year, that's a 5% increase on the full value of the property, even though you only invested a fraction of that value. This means that real estate investors can build wealth at a faster rate than those investing in other assets that don't allow for such high levels of leverage. But it's not just about leverage and appreciation. Cash flow is a critical component of real estate investing as well. When you own a rental property, the rent you collect from tenants provides you with a steady stream of income, often enough to cover your mortgage payments, property expenses, and still leave you with a profit. And here's where the tax benefits come in again. The cash flow generated by your property is often taxed at a lower rate than ordinary income. In some cases, depending on your tax bracket and the amount of deductions you can claim, you may even be able to offset your rental income entirely, meaning you won't pay taxes on it at all. This is where real estate becomes especially attractive for high-income earners. As Wheelwright explains, when you have other sources of income, such as a high-paying job or a profitable business, the tax code allows you to use the deductions from your real estate investments to offset your income from other areas. This means that if you're earning a significant salary from your job, you can use real estate deductions, like depreciation and mortgage interest, to lower your overall taxable income and keep more of what you earn. One of the most exciting aspects of real estate, according to Wheelwright, is that the benefits compound over time. The longer you hold onto a property, the more you benefit from appreciation, the more cash flow you generate, and the more deductions you can claim. Over the years, this creates a snowball effect, allowing you to continue building wealth while paying less and less in taxes. As your portfolio grows, so do your tax advantages, creating a virtuous cycle of wealth accumulation. But what about the risks? Isn't real estate risky? Wheelwright acknowledges that all investments come with risks, but he argues that real estate, when done correctly, is one of the most stable and reliable ways to build wealth. Unlike stocks or other volatile assets, real estate provides tangible value. People will always need a place to live, and as long as you're investing in properties with strong demand, your risk is relatively low compared to the potential rewards. Moreover, the tax benefits of real estate investing help mitigate some of the risks. Even in a down market, when property values may decline, you can still take advantage of depreciation deductions, mortgage interest deductions, and other tax benefits that reduce your taxable income. And because real estate is a long-term investment, short-term fluctuations in property values are less of a concern when your focus is on generating cash flow and building wealth over time. Wheelwright also points out that real estate offers investors a high level of control compared to other investments. With stocks or mutual funds, you have little say over how the companies you invest in are run. But with real estate, you're in control. You can decide which properties to invest in, how to manage them, and when to sell. This control allows you to take a more active role in building your wealth and managing your tax liability. As the chapter comes to a close, Wheelwright emphasizes that real estate is not just for the wealthy. It's a vehicle that anyone can use to build financial independence. Whether you're starting with a small single-family rental or investing in larger multi-family properties, the tax advantages and wealth-building potential of real estate are available to everyone. The key is understanding how the tax code works and using it to your advantage. Chapter 7. How entrepreneurs pay less tax. By now, you've seen how real estate is a game changer for building wealth while minimizing taxes. But Tom Wheelwright doesn't stop there. In this chapter of Tax-Free Wealth, he reveals how entrepreneurs, much like real estate investors, are uniquely positioned to benefit from the tax system. If you thought owning a business was just about creating products or services and earning money, think again. Wheelwright opens up a world where being an entrepreneur gives you unparalleled control over how much tax you pay, making it one of the most effective strategies for growing wealth. Let's start with a key insight. The tax code is fundamentally designed to reward business owners. Why? Because businesses drive the economy. They create jobs, stimulate innovation, and contribute to economic growth. Governments around the world want to encourage entrepreneurship, and they do this by offering significant tax incentives to those who own and operate businesses. As Wheelwright explains, when you own a business, you gain access to a wide range of deductions, credits, and tax strategies that are simply not available to employees earning a paycheck. So, why do entrepreneurs pay less in taxes? It comes down to one crucial difference. Employees earn their money, pay taxes, and then live off what's left. Entrepreneurs, on the other hand, earn money, invest it back into their business, and only pay taxes on what's left after they've deducted their business expenses. This fundamental difference gives business owners the ability to control their tax burden in ways that employees cannot. Let's break this down further. When you're an employee, your taxes are deducted from your paycheck before you even see it. You have little control over how much is taken out, and your options for reducing your taxable income are limited to things like retirement contributions or charitable donations. But as an entrepreneur, the game changes completely. You have the ability to deduct a wide variety of expenses related to running your business, which means you only pay taxes on your net income. What's left after expenses have been subtracted. The more legitimate business expenses you have, the lower your taxable income. Wheelwright emphasizes that the types of expenses you can deduct as a business owner are extensive. If you're operating out of a home office, a portion of your rent or mortgage can be deducted. Your internet, utilities, and even the depreciation on your office furniture can be written off. Travel for business purposes, whether it's meeting with clients, attending conferences, or scouting new business opportunities, can be deducted as well. And let's not forget about meals and entertainment expenses, which, when conducted for business purposes, can also reduce your taxable income. But it's not just about the obvious deductions like rent, utilities, and travel. Wheelwright explains that nearly every aspect of your life can potentially become a business expense if it's related to your work. For example, if you run a business that involves using a vehicle, whether you're driving to meetings or transporting goods, you can deduct the cost of operating that vehicle, including gas, maintenance, and even depreciation. If you hire employees, their salaries and benefits are deductible. If you invest in training or further education to improve your business skills, those costs can be written off as well. This is where owning a business becomes particularly exciting from a tax perspective. While employees are limited in their ability to reduce their taxable income, entrepreneurs have a multitude of options. Every legitimate business expense reduces the amount of money that is subject to taxation, allowing business owners to keep more of their earnings. One of the most powerful tax-saving strategies for entrepreneurs, as Wheelwright explains, is setting up the right type of business entity. Not all businesses are taxed the same way, and the structure you choose can have a significant impact on how much tax you pay. Wheelwright discusses the differences between sole proprietorships, partnerships, limited liability companies, LLCs, and corporations, emphasizing the importance of selecting the right structure based on your goals and the size of your business. For many small businesses, an LLC is a popular choice because it provides liability protection for the owner while allowing the business's income to pass through to the owner's personal tax return. This means that the business itself doesn't pay taxes, only the owner does, based on the income they receive from the business. S corporations and C corporations offer different tax advantages, particularly for larger businesses. And Wheelwright explains how these structures can help business owners reduce their taxes even further. Now, one of the key concepts Wheelwright introduces in this chapter is the idea of pass-through entities. These are business structures where the income generated by the business passes through to the owners and is taxed at the individual level rather than at the corporate level. This is a huge advantage because it avoids the dreaded double taxation that occurs with C corporations, where the corporation is taxed on its profits and then shareholders are taxed again on dividends. Pass-through entities like LLCs and S corporations allow business owners to avoid this double hit. But setting up the right entity is just the beginning. Wheelwright emphasizes that once your business is structured properly, it's time to start thinking strategically about taxes all year long, not just when it's time to file. Many business owners miss out on significant tax savings simply because they don't plan ahead. For instance, you can time your purchases and expenses to maximize deductions in a given year. If you know you're going to have a particularly profitable year, you might choose to make large purchases, such as equipment or property, before the end of the year to take advantage of immediate deductions. One of the key takeaways from this chapter is the importance of understanding the difference between personal expenses and business expenses. Wheelwright warns that while it's tempting to write off as many expenses as possible, you must ensure that they're legitimately tied to your business. The IRS is strict about this, and if you're audited, you'll need to provide documentation showing that the expenses were necessary and ordinary for your business. This is why keeping detailed records is critical. If you're unsure whether an expense qualifies as deductible, Wheelwright advises consulting with a knowledgeable tax advisor who can guide you. But here's where entrepreneurship gets even more exciting: tax credits. In addition to deductions, business owners can also take advantage of various tax credits that directly reduce the amount of tax they owe. Unlike deductions, which reduce taxable income, tax credits are a dollar-for-dollar reduction in your tax bill. Wheelwright highlights several types of credits that entrepreneurs can use, such as credits for hiring employees, investing in research and development, and providing healthcare benefits. These credits can dramatically lower your tax bill and, in some cases, result in a tax refund even if you didn't owe any taxes. By the end of this chapter, Wheelwright has made it clear that being an entrepreneur offers some of the most powerful tax-saving opportunities available. The tax code is designed to encourage business ownership, and those who understand how to navigate it can build significant wealth while paying less in taxes. But Wheelwright also cautions that the key to success as an entrepreneur is planning. Taxes aren't something you think about just once a year. They should be part of your business strategy from the start. This chapter leaves you with a sense of possibility. Owning a business isn't just about pursuing your passion or creating financial independence. It's also about taking control of your tax situation in a way that employees simply can't. As you begin to think about your business or future business in this way, you'll see that entrepreneurship is one of the most effective ways to build long-term wealth, minimize taxes, and achieve financial freedom. Chapter 8: The Tax Benefits of Investing in Energy and Agriculture. As you've already learned in previous chapters, certain types of investments offer incredible opportunities to build wealth while significantly lowering your tax burden. Tom Wheelwright now takes us into two industries that offer even more enticing tax benefits: energy and agriculture. These sectors might not seem like the obvious choices for the average investor, but they hold some of the most substantial tax advantages available, which can help you build wealth while contributing to societal needs such as food production and energy sustainability. In this chapter of Tax-Free Wealth, Wheelwright highlights how governments use the tax code to encourage investments in sectors they deem critical to the country's future. Energy and agriculture, as essential components of any economy, often receive substantial support in the form of tax incentives. Wheelwright emphasizes that these industries aren't just for big corporations or wealthy investors. With the right knowledge, everyday investors can also tap into the tax-saving opportunities that come with energy and agriculture investments. Let's start with energy. Governments around the world, including the United States, are increasingly focused on reducing reliance on fossil fuels and promoting renewable energy sources like solar, wind, and geothermal power. To stimulate investment in these clean energy technologies, they offer significant tax incentives, particularly through tax credits. Tax credits, as Wheelwright reminds us, are one of the most powerful tools in the tax system because they provide a dollar-for-dollar reduction in your tax bill, rather than just reducing your taxable income like a deduction. One of the most notable incentives for energy investors is the Renewable Energy Investment Tax Credit, ITC. This tax credit allows individuals and businesses that invest in renewable energy projects, such as installing solar panels or building wind farms, to claim a percentage of the project's cost as a credit against their taxes. In the United States, the ITC covers 26% of the cost of a solar energy project, meaning that if you invest $100,000 in solar energy, you can reduce your tax bill by $26,000. Wheelwright explains that these incentives are not limited to large energy companies or utility providers. Individuals can take advantage of them too. For example, if you install solar panels on your home or business, you can claim the tax credit. But the benefits don't stop there. In addition to the ITC, renewable energy projects also allow for depreciation deductions. Just like with real estate, you can depreciate the cost of your solar panels or wind turbines over time, further reducing your taxable income. The combination of tax credits and depreciation makes energy investments particularly attractive from a tax perspective. For those who are more ambitious, investing directly in large-scale renewable energy projects, such as owning a stake in a wind farm or a solar energy company, offers even greater tax benefits. Not only do you receive the tax credits and depreciation deductions, but you also generate income from the sale of the electricity produced by these projects. And here's the exciting part. The income you earn from renewable energy investments is often subject to lower tax rates, especially when paired with the generous deductions and credits available. Wheelwright urges readers to explore these opportunities, especially as governments continue to prioritize renewable energy in their tax policies. But energy isn't the only industry where tax benefits abound. Agriculture is another sector where governments provide substantial tax incentives to encourage investment. Like energy, agriculture is a vital part of the economy, and governments recognize the need to support food production and rural development. Wheelwright explains that agriculture investments, whether in farmland, livestock, or agricultural equipment, offer a wide range of tax advantages that can help investors reduce their tax liability while supporting the production of essential resources. One of the key tax benefits associated with agriculture is the ability to deduct the cost of land improvements, machinery, and equipment. If you invest in a farm or agricultural operation, many of the expenses associated with running that farm, such as the purchase of tractors, irrigation systems, or even livestock, can be written off as business expenses. Like in other industries, depreciation plays a significant role in reducing taxable income. Agricultural machinery and equipment can be depreciated over time, allowing you to recover the cost of these assets while simultaneously reducing your tax burden. But that's not all. Agriculture also offers unique tax advantages related to land conservation. Many governments, particularly in the United States, provide tax incentives to landowners who engage in conservation efforts, such as protecting wetlands, forests, or other ecologically important areas. If you own agricultural land and choose to conserve part of it, you may qualify for tax credits or deductions that significantly reduce your taxes. In some cases, landowners who donate land for conservation purposes can even receive deductions equal to the fair market value of the land. In addition to conservation efforts, There are tax benefits related to government subsidies and grants. Many agricultural operations, especially in rural areas, receive financial support from the government in the form of subsidies, which can further reduce the tax burden on farmers and agricultural investors. These subsidies, combined with depreciation and deductions for operating expenses, create a favorable tax environment for anyone looking to invest in agriculture. But perhaps the most exciting part of investing in agriculture is the potential for long-term, generational wealth. Farmland has historically appreciated in value over time, making it a solid investment not only for producing income through crops or livestock, but also for building long-term equity. Wheelwright explains that, much like real estate, farmland offers opportunities for appreciation while providing ongoing cash flow through agricultural production. And just like with other asset classes, the income generated from agricultural investments is often taxed at lower rates, especially when combined with the numerous deductions and credits available to investors. At this point, you might be thinking that energy and agriculture investments sound great for people with millions of dollars to spend, but what about the average investor? Wheelwright emphasizes that you don't need to be a billionaire to take advantage of these tax benefits. There are many ways to get involved in energy and agriculture, from small-scale investments like installing solar panels on your property or purchasing shares in an agricultural cooperative, to more substantial investments like owning farmland or participating in a renewable energy project. One of the most important lessons Wheelwright imparts in this chapter is the idea of aligning your investments with government incentives. Energy and agriculture are two industries that are heavily supported by the government because they serve the public good. By investing in these sectors, you're not only building wealth for yourself, but also contributing to the country's energy independence and food security. And the government rewards you for doing so through generous tax benefits. As Wheelwright concludes the chapter, he reiterates that understanding the tax code allows you to make smarter investment decisions. Energy and agriculture, while perhaps not the most glamorous industries, offer some of the most powerful tax-saving opportunities available. Whether you're interested in renewable energy, sustainable farming, or land conservation, the tax incentives are there for the taking. All it takes is the willingness to explore these opportunities and align your investment strategy with the government's priorities. Chapter 9. Avoiding Common Tax Mistakes. By now, you've learned how to harness the tax code to build wealth through real estate, entrepreneurship, energy, and agriculture. Tom Wheelwright has shown you that the tax code isn't just a series of rules designed to take your money. It's a roadmap to financial success. But even the most well-prepared and strategic investors can run into trouble if they're not careful. In this chapter of Tax-Free Wealth, Wheelwright delves into the common tax mistakes that can trip up even the most seasoned individuals and entrepreneurs. Avoiding these mistakes is just as important as understanding the tax benefits, because one misstep could result in overpaying on taxes, or worse, facing penalties from the IRS. Imagine you've spent an entire year meticulously following the tax strategies you've learned. You've taken advantage of deductions, credits, and depreciation. Then tax season comes, and a seemingly small oversight wipes out all of those hard-earned savings. It's a scenario that's far too common, according to Wheelwright, but it's also one that's easily preventable with the right approach. The first major mistake Wheelwright addresses is the failure to keep adequate records. It may sound simple, but the importance of proper documentation cannot be overstated. Every deduction, every credit, every expense that you claim must be backed up by detailed records. Whether it's receipts for business expenses, mileage logs, or documentation for depreciation, having accurate and organized records is essential to proving that your tax filings are legitimate. Without them, you're leaving yourself vulnerable to scrutiny. And if you're ever audited, you could lose the ability to claim the deductions and credits you've worked so hard to earn. Wheelwright stresses that many people make the mistake of being too relaxed about record keeping, especially when it comes to small, everyday expenses. You might think that a meal here or a travel expense there isn't worth the hassle of documenting. But over time, these small deductions add up, and losing them could significantly impact your tax savings. In the event of an audit, the IRS doesn't care how legitimate your expenses are if you don't have the paperwork to prove it. Wheelwright recommends developing a simple, consistent system for tracking your expenses, whether it's a digital tool or good old-fashioned paper files. The key is consistency and detail. Another common mistake Wheelwright sees is mixing personal and business expenses. This is a particularly easy trap to fall into for entrepreneurs and small business owners. When your personal and business lives are closely intertwined, it's tempting to pay for things like meals, travel, or even vehicle expenses from the same account, without carefully distinguishing which expenses are personal and which are for business. This can lead to confusion when it's time to file your taxes and, in some cases, result in improperly claimed deductions. The solution, Wheelwright explains, is to maintain clear boundaries between your personal and business finances. If you own a business, set up separate bank accounts and credit cards for business-related transactions. This not only makes it easier to track and document your expenses, but also protects you in the event of an audit. When your finances are clearly separated, it's much easier to prove that your deductions are legitimate and you won't risk claiming personal expenses as business deductions. But what if you use something for both personal and business purposes? For example, many entrepreneurs work from home, which means that their home office is both a personal and business space. Wheelwright explains that it's perfectly legal to deduct part of your home office expenses as long as the space is used exclusively for business purposes. But you need to be meticulous in tracking how much of your home is used for work and calculating the percentage of expenses, such as rent, utilities, and internet, that can be attributed to your business. This is an area where many people make mistakes, either overestimating the deductions they can take or failing to claim them altogether out of fear of doing it wrong. Another area where entrepreneurs often trip up is with employee-related expenses. If you own a business and have employees, you can deduct their wages, benefits, and even training expenses. But many business owners make the mistake of improperly categorizing their workers, especially when it comes to independent contractors versus employees. The IRS is very strict about the difference between these two categories, and misclassifying a worker can result in hefty penalties. Wheelwright warns that you must be careful to follow the IRS guidelines for determining whether someone is an independent contractor or an employee, and that you should consult with a tax advisor if you're unsure. One of the most significant mistakes that people make when it comes to taxes is not planning ahead. Wheelwright emphasizes that tax planning is not something you should do only once a year, when it's time to file your return. By that time, it's often too late to implement strategies that could reduce your taxes for that year. Instead, Wheelwright advocates for proactive tax planning, thinking about taxes as part of your overall financial strategy throughout the year. Whether it's timing your purchases and expenses to maximize deductions or making decisions about when to sell assets, being proactive can save you a significant amount of money. For example, if you know that you're going to have a particularly profitable year, you might choose to make large investments, such as buying equipment for your business or investing in real estate, before the end of the year to take advantage of depreciation or other tax deductions. Similarly, if you're planning to sell an asset, you might delay the sale to the following year if you expect your income to be lower, which would reduce the taxes you owe on the sale. The key, Wheelwright explains, is to think ahead and plan your tax strategy in advance, rather than reacting at the last minute. In addition to failing to plan ahead, many people also make the mistake of not working with a qualified tax advisor. Wheelwright is clear that while it's possible to learn the basics of tax strategy on your own, there's no substitute for working with an experienced professional who can help you navigate the complexities of the tax code. But not all tax advisors are created equal. Wheelwright cautions that many accountants focus solely on tax compliance, filing your return accurately and on time, without offering much in the way of strategic advice. What you need is a proactive tax advisor, someone who will work with you throughout the year to help you minimize your taxes and maximize your wealth. A proactive tax advisor can help you identify opportunities to reduce your taxes that you might not be aware of, such as claiming tax credits, taking advantage of bonus depreciation, or setting up the right type of business entity. They can also help you avoid common mistakes, like failing to document expenses or misclassifying employees. The right advisor will not only save you money on taxes, but also give you peace of mind, knowing that you're following the rules and making the most of the tax code's incentives. But perhaps the biggest mistake people make, according to Wheelwright, is thinking that they can't control their taxes. Many people believe that taxes are simply something that happens to them, and that they have little to no control over how much they pay. This couldn't be further from the truth. As Wheelwright has shown throughout the book, the tax code is full of opportunities to reduce your taxes, if you know how to use it. The key is understanding the rules of the game and being proactive in your approach. By the end of this chapter, Wheelwright has made it clear that avoiding tax mistakes is just as important as taking advantage of tax-saving opportunities. With proper planning, careful record-keeping, and the right guidance, you can steer clear of the common pitfalls that trip up so many people. Taxes don't have to be a source of stress or confusion. With the right mindset and the right strategy, you can take control of your taxes and use them as a tool for building wealth. As we move into the final chapter, Wheelwright will tie together all the lessons you've learned so far and offer practical advice for choosing the right tax advisor and maintaining a long-term tax strategy that evolves with your financial goals. Chapter 10. Choosing the right tax advisor. By this point in tax-free wealth, Tom Wheelwright has equipped you with an arsenal of tax-saving strategies that can help you grow your wealth while legally minimizing the amount you pay in taxes. From deductions and credits to depreciation and business structures, you've learned how the tax system is filled with incentives designed to reward those who invest in their businesses, real estate, and other key areas of the economy. But to fully leverage these strategies, there's one more critical step: choosing the right tax advisor. This chapter focuses on finding the advisor who can help you not only comply with the tax laws, but also implement strategies that will save you money year after year. Wheelwright opens this chapter with a key piece of advice. Not all tax advisors are created equal. Just as you wouldn't choose any doctor to perform a complex surgery, you shouldn't pick just any accountant to handle your taxes, especially if you're serious about growing your wealth. Taxes are a significant part of your financial life, and having the right advisor can make all the difference between merely filing your taxes and using the tax code to your advantage. The first thing Wheelwright wants you to understand is the difference between tax compliance and tax strategy. Most accountants and tax preparers focus solely on compliance. They help you fill out the necessary forms, file them with the IRS, and ensure that you're following the rules. While this is important, it's only the first step. Tax compliance ensures that you're paying what you owe, but it doesn't do much to help you minimize what you owe. This is where tax strategy comes in, and it's where the right advisor can truly shine. A proactive tax advisor doesn't just file your taxes once a year. They work with you throughout the year to develop and implement a tax strategy tailored to your specific financial situation. This involves understanding your business, your investments, and your financial goals, so that they can help you make decisions that reduce your tax liability. As Wheelwright explains, the tax code is full of opportunities, but most people miss out on them simply because they don't have the right advisor guiding them. So, how do you find the right tax advisor? Wheelwright provides a step-by-step approach to selecting an advisor who can help you achieve your financial goals. The first step is to look for someone who specializes in tax strategy, not just tax compliance. You want an advisor who understands the tax-saving strategies discussed in this book and who can apply them to your unique situation. This means finding someone who has experience working with entrepreneurs, real estate investors, or professionals in your industry. A good tax advisor will be proactive in finding ways to save you money, not just reactive in filling out forms. Another important factor to consider is whether the advisor takes a long-term view of your tax situation. Taxes aren't something that should be dealt with only once a year when you file your return. A great tax advisor will work with you throughout the year, helping you plan for major financial decisions and ensuring that you're maximizing your tax-saving opportunities. Whether it's timing the sale of an asset, setting up the right type of business entity, or planning for retirement, your tax advisor should be involved in these decisions from the start, not after the fact. Wheelwright also emphasizes the importance of communication. A good tax advisor will take the time to explain things to you in a way that you understand. They should be able to break down complex tax concepts and show you how they apply to your specific situation. You shouldn't have to feel intimidated or confused when talking to your tax advisor. Instead, you should feel empowered, knowing that they are helping you navigate the tax system with confidence. If an advisor can't explain things clearly or seems too busy to answer your questions, that's a red flag. One of the key qualities to look for in a tax advisor is creativity. The tax code is vast and complex, but it's also full of opportunities for those who know how to think outside the box. A great tax advisor will be able to identify strategies that other advisors might overlook. For example, they might suggest ways to structure a deal or an investment that reduces your taxes in ways you hadn't considered. This doesn't mean engaging in risky or unethical behavior. Wheelwright is clear that all strategies should be legal and compliant with the tax code, but it does mean thinking strategically about how to maximize your benefits. In addition to finding a creative and proactive advisor, Wheelwright suggests that you look for someone who is well-connected. Taxes are just one part of your financial picture, and the best advisors will have relationships with other professionals who can help you in areas like legal advice, investment planning, and insurance. A well-rounded tax advisor will be able to refer you to experts in these areas, helping you create a comprehensive financial plan that goes beyond just taxes. Another important point Wheelwright raises is the need for ongoing education. The tax code is constantly changing, and a great tax advisor will stay up to date with the latest developments. Whether it's new tax laws, court rulings, or changes in government policy, your advisor should be continually learning and adjusting their strategies to keep you ahead of the curve. This is particularly important for high-net-worth individuals and business owners, as tax laws affecting these groups can change frequently. Wheelwright recommends asking potential advisors about how they stay informed and how often they update their clients on changes in the tax code. When you're choosing a tax advisor, Wheelwright advises conducting a thorough interview. Don't be afraid to ask tough questions about their experience, their approach to tax strategy, and how they've helped clients save money in the past. Ask for specific examples of how they've implemented tax-saving strategies for clients in similar situations to yours. A great advisor will be able to provide these examples confidently and explain how they can apply similar strategies to your financial life. But perhaps the most important piece of advice Wheelwright offers is to trust your instincts. Taxes are a deeply personal part of your financial life, and you need to feel comfortable with the person who's handling them. If something feels off, whether it's a lack of communication, a reluctance to answer questions, or an overly aggressive approach to tax savings, don't hesitate to move on and find someone else. The right tax advisor should make you feel confident and empowered, not worried or confused. Wheelwright closes the chapter by emphasizing that your tax advisor is one of the most important members of your financial team. Having the right advisor can save you thousands, if not tens of thousands, of dollars in taxes every year. But more than that, the right advisor can help you create a long-term tax strategy that evolves with your financial goals. As your business grows, as your investments increase, and as your financial situation becomes more complex, your tax strategy should grow with you. A great tax advisor will be there every step of the way, helping you navigate the tax system and make smart decisions that lead to long-term financial success. In the final chapter of Tax-Free Wealth, Wheelwright ties everything together and offers practical advice for maintaining a long-term tax strategy. By now, you understand the power of the tax code and how it can be used to your advantage. The key is to remain proactive, work with the right professionals, and continually adjust your strategy as your financial situation changes. Taxes aren't something to be feared. They're a tool that, when used correctly, can help you achieve true financial independence.